Good morning. This is Tara Sewell, Internal Wholesaler. Thank you for joining us today. We have a special guest from National Life Group to discuss fixed indexed annuities. Now, your phones are muted for sound quality, but if you have questions, you can type your question in the chat box in the GoToWebinar window. You also will have an opportunity to raise your hand at the end of the presentation if you would like to vocally ask your question. We will be addressing these questions following the presentation. This summer, America celebrates 250 years. We have a special promotion, America 250. In addition to your normal compensation, you will earn up to $50 prepaid credit card per paid policy between April 1st and August 2nd. For applications submitted and paid during this time, you will receive $25 for each paid policy. You will receive a $25 bonus for each policy that was submitted via e-application on our website, www.fmiAgent.com. Each application submitted and paid will also earn you tickets for our live drawing to be held on August 13th. We will be giving away one 24-karat gold layered framed Declaration of Independence plaque. Now, this picture does not do it justice. It truly is a beautiful art piece. Today, we welcome our guest, Craig Geiger from National Life Group. He is the National Accounts Manager for Independent Distribution at National Life Group, specializing in annuities. Craig has been in the financial services industry since 1997 and began his career as a financial advisor, then moved to the corporate side as an annuity external wholesaler. Craig helps financial professionals with positioning ideas, case design, marketing concepts, and best practices. Craig has a Series 6 and Series 63, as well as life and health licenses. Thank you for joining us today. Craig?
Thank you, and thanks for to Financial Markets for giving me an opportunity to spend some time with you today. I think today's call is very timely. A couple of weeks ago, actually, I saw an article that was titled, "Is your retirement ready for the next crisis?" And I thought that was kind of fitting because when you think about the amount of people that are retiring in this country, and we all know that baby boomers have certainly gotten a lot of attention over the years, and for good reason, because believe it or not, they control the vast majority of all the wealth in this country, and 11,400 a day are turning 65. That's about 4.1 million people a year over the next couple of years. So we know that's a real thing, and safeguarding assets and protecting assets, I think, are going to become more and more important, especially as people transition from growing their money and putting money away for retirement to eventually getting into retirement, which kind of speaks about what we're going to talk about today, which is the fixed index annuity and getting back down to the basics. Because at the end of the day, products get more complicated. It's all about simplifying our story in the way in which we present this to the client in a way that they're going to be able to connect with and understand better and understand the value that it provides. So when you think about today's presentation, it's really going to be in a couple different categories. One, we're going to talk about the challenges that people are seeing out there today. We're going to talk about the solution or the story with the fixed index annuity, and then we're going to talk about the ability to understand the opportunity you have in front of you when it comes to your book of business. And then we'll kind of also dive into why NLG, kind of go through some of our product solutions, our top producer bonus program, and of course our trip for next year on this year's production. So let me kind of dive into balancing growth and safety in retirement, because that's an important thing to be talking about. Because when you think about the amount of money that's sitting on the sidelines right now, we've never seen more money on the sidelines right now than we do at this point. Because when you think about people that have safe money, we think about bank instruments, we think about money market accounts, we think about CDs. And the reality is there's more money sitting on the sidelines now than ever before. And the question is, what's driving that? And I think a big driver of that, if we get back to the basics, is it's fear. People are fearful to put their money at risk when it comes to the market. And that's a big emotional driver. So when you look at this particular thing on the screen right now, you see that on one side of it, it says fear of loss. That's what's driving, I think, a lot of reaction toward going to safe money investments or cash on the sidelines. But on the other side of it, on the other side of the spectrum, if you will, we're all human and we all have that fear of missing out, or what's called FOMO. And that's typically people that invest in the market because they don't want to give up that upside, right? But the thing is, we all know if investing in the markets is sometimes if you have all the upside, you get all the downside risk too. So there's got to be this middle ground, this balancing act we can provide that can give people, especially people that are a little more conservative in nature, the ability to satisfy their fear of loss with protection on their principal and their gains, but at the same time giving them that upside potential on the other side. And that's really where the FIA kind of creates that balanced solution, giving that person the ability to, one, satisfy that fear of loss concern with knowing, hey, this is why we're using the fixed index annuity. It's built to give you that protection while still giving you what I call more upside capture opportunity for the growth than what other safe investments are currently giving them, like a CD, like a money market account, or money that's sitting in cash. So when we think about that, it all kind of comes down to the next thing we'll see on the next part of the presentation on the next slide. And that's, of course, the challenges what so many people are seeing. And one thing we know is inflation, we all know, went through the roof during COVID. Now, everyone remembers that. And you can see here, you look at milk in 2004 was $3.16. By 2024, it was almost $7. That's almost a 40% increase. Eggs were $1.34 in 2004. They were almost $10. That's a 615% increase. Now, let me put this into perspective in a way that really can help your clients understand how inflation erodes their purchasing power over time. And that's what I call the Big Mac Index. So if you Google Big Mac Index, that's a real thing. That's a real website. And what it's meant to do is to give somebody the idea or have a better harness of understanding of what inflation does to your purchasing power. And if you look there, and I actually looked up these numbers before the call here today, just to kind of give you a rundown. If you think about a Big Mac at McDonald's, in 1980, it cost about 70 cents. But by 1986, so not that far forward, it was more than double that. It was $1.60. I don't know about you, but that kind of reminds me of what happened during COVID. Almost everything went up way in price real quick, right? Now, if we look at 1990, a Big Mac cost about $2.70. So yeah, that inflation was starting to go, but it was more slowly, right? By 2009, it was $3.57. But during COVID, a Big Mac got close to $6 to $7, depending on where you were in the country. So to me, that's a real thing when you think about inflation. The other part of it, of course, is market volatility. And I think this is a big driver why so many people are sitting on the sidelines. If we can go back to the screen before real quick. If you look back here and you look at the numbers here, look at what happens when things go tough, things go wrong with the market, right? When market volatility gets really high, people tend to run to cash. If we think about the last three major market events, think of the tech bubble, think of the global financial crisis, think about COVID. All of those things were huge market events that people got their money out of the market and ran to cash. So if you look at the assets in money market accounts, it's not a surprise. There's a correlation between when the market goes down, people run to safety, right? And you look at the Q4 numbers on money market account assets. In 2001, again, right after the tech bubble, we hit a new high of money market account assets at $2.4 trillion. At that time, that was a new high. You look at Q4 of 2008, during the global financial crisis, it was up to $3.8 trillion. And of course, look at Q4 of 2020 during COVID, it went up all the way up to $5 trillion. And by Q4 of 2024, it went up to $7.2 trillion. Now, I looked up the numbers in terms of what they are in 2026, and as of February of this year, it's all the way up to $7.7 trillion. So the numbers aren't going down. If you look at the history on the next slide here, you can see the chart's actually going to show you that typically when the market starts getting better, money market account assets drop back down and money goes back in the market. If you look at from 2020 on, that isn't happening. In fact, there's more people than ever putting money in on the sidelines because they're probably fearful of loss. Even though the market's been on a tear, they've been putting more and more and more money into safe investments like a money market account. So when you think about that, that's a big, big emotional driver as to why people are doing what they're doing with their money. So let's go to the next slide here. And what we're going to talk about here is really what I call the mathematics of a loss. And I think this is a very important thing to share with clients is that, listen, I know you're fearful of loss, or maybe they're in the market, but sometimes as they get older, they don't recognize the challenges and the risks that they're taking, especially if the market has a downturn. And I always like to ask the question is, hey, if you have $1 million in your investment portfolio right now, if you took a 20% loss this year, how much would you need to make next year just to get yourself back to $1 million? You took a 20% loss, so now your portfolio is worth $800,000. How much would you need to make in 2027 just to get yourself back to that $1 million number? Not even making any gains, just to get yourself back to even. You'd have to make 25%. And again, we all know with the market, there's nothing that's guaranteed in the market. The market goes up, the market will go down. We don't control that, right? But the reality is they would need to get a bigger return on a smaller piece of money just to get themselves back to even. And then if you start adding in the fact, let's say you're taking a 5% withdrawal, or let's say over a 5-year period of time, look at the numbers are even higher than that. So the reality is a lot of people get to a point in their life. My dad said this all the time when he was a financial advisor for over 35 years. And I remember him saying this to me when I was younger, when I first got in the business in my 20s. He's like, Craig, let me tell you something. Let me tell you something about my older clients. A lot of them have what's called this longevity moment in their life. Typically when they get in their late 50s, early 60s, they start recognizing that they have less days ahead than they do behind. And I never really understood that when I was younger, but now that I'm 52, I really do understand that logic. Because as we get older, we have less days ahead of us, which means we have less time to make up for any losses or mistakes we make, or the challenges the market can put on our portfolios. So protection and safeguarding assets becomes more important than just all about the performance, right? So when you have less days ahead than you do behind, you can't afford to make a mistake, which I think is a big driver for why a lot of people are maybe sitting in cash right now. They're just fearful of loss, which makes a ton of sense. As we go to the next slide here, it's all about understanding how the power of protection can actually work, but going through a prime example of this with the client. And so this is what I call the lost decade. Didn't need to be lost. When you think of the lost decade, that was a 10-year period of time when you put money in the market, and by the end of that 10 years, you only had about 74 to 75% of your original investment at the end of that period of time, which means you actually had less money than what you put into it. Even though the market was up 6 years, it was only down 4 years. But it's all about that sequence of return risk. When are those losses going to hit, and how much is that going to impact my portfolio, and how long is it going to take me when the market starts coming back, not only to get myself back to even, but to get myself ahead where I might even have a gain. So what I want to do is just kind of just as an example here, let's look at this chart here. And what I want you to do is I want you to follow along with that gray line first. And you can see here, we put $100,000 in the market in 1999. And again, we're using the S&P as a benchmark here. We can see here that those first 3 years were significantly down. You went from 100,000 to 93,820, down to 82,242, all the way down to 65,316, which means you only have 65% of your original investment just after 3 years. Now, a good thing is eventually the market started bouncing back, but look how long it took you just to get yourself even close to being even, and that was 2005, and by 2006, you actually were ahead again. So it took you years of positive performance to grow that depleted portfolio back to potentially your original number of 100,000. Luckily, by 2006, you had 108,501, so you actually were positive again. But look how many years that took you to get yourself back to that number. Unfortunately, for a lot of clients is, yes, the market was up the following year, but what happened in 2008? The global financial crisis. And what happened with that 113,220 you had? It dropped all the way down to 74,396. So you literally walked away with less money than you started over a 10-year period of time. Now, what does the power of protection do for a client with the fixed index annuity? Well, let's follow along with the green line now. Same $100,000 we put in 1999. Those first 3 years, this is where that power protection really plays into this example here. what you're seeing here is even though the market was down significantly those first 3 years, you were completely protected. So your $100,000 initial investment is still worth $100,000 3 years later. But the minute the market started showing some appreciation, you get a percentage of that upside, what I call upside capture opportunity. So you were able to lock in that gain, create a new floor in your contract value. So you look at 100,000, then it went to 107. Again, that's your new floor on your contract value. The next year went up again. You're now at 114,000. You're at 122,000 the following year. Then you're up to 131,000. And then again, you get up to 136,000 and some change. Now, mind you, remember that last year in 2008 when the market was down? Look how you were fully protected from that downside risk of the markets. So your walkaway at that point was 136,781. So what this is showing you is the power protection on the front end. Even though we had significant loss in the market, you were protected. But the minute the market starts showing some appreciation, you have the potential on the upside to get some of that upside capture opportunity and lock in those gains along the way and create a new floor again on your contract value. Let's go to the next slide. The question comes up a lot. By the way, this is already outdated, so this is definitely going to get updated soon. But a big question, a lot of people, especially people that are more conservative investors, always say, well, it seems like the market's down more than it's up. At least that's how the media kind of pushes the narrative. The market's always down all the time. But if we actually pop the hood and actually look at the growth engine of the S&P 500 as a benchmark for growth, from 1957, now you can say from 2025, the market's actually been up 50 of those years, and it's only been down only 19 of those years. So just looking at the numbers, just looking at his history, the market tends to be up more than it's down. But when it's down, you have that protection wrapper built in with the fixed index annuity. When the market's up, you get a percentage of that upside potential and capture those gains along the way. And again, create a new floor on your contract value. Let's go to the next slide. Now, to me, this is where things can really change the narrative in terms of having that discussion with clients, because I'm a big believer that keeping things simple is the best way to present, because the more we make things complicated, the harder it is to understand the value that a fixed index annuity or other investments can provide, right? So I always want to connect the dots with something that the client's already going to understand. And home ownership is something that most people can understand. They understand that, hey, the home is where I live, but it's also in some ways can be an investment, because obviously I'm hoping it's going to go up in value over time, right? So if you look, kind of use that same logic here and use a house. What I always do is I always do a T-chart. I do a T-chart, I put house A on the left side, I put house B on the other side. And what I'm trying to do is say, listen, if we just looked at the S&P 500 from 2000 to 2010, so kind of in that lost decade range, and we're using the S&P as the benchmark for the growth of the home, but also the downside of the home, right? Because we all know with the market, you've got all the upside, but you get all the downside risk too. So using that same logic, and we all know with home ownership, you've got all the upside, but the one thing we know about real estate, especially after the global financial crisis, is real estate doesn't always go up anymore. It can very well go down. So if we use that same logic, house A is the way you're used to buying a home. Put $100,000, I buy that house today for $100,000. I know no house costs $100,000. We're just going to use that for simple math. And if I use the benchmark of the S&P as the growth engine, but with all the downside too, $100,000 house would only be worth about $75,883 at the end of that 10-year period. So you literally have less value in your home than what you bought the house for 10 years prior. But what if we had that power of protection? What if there's a different way to buy a house? And I'm going to say, I'm going to give you a percentage of the upside. And anytime you have any appreciation, we're going to lock that value in the price of your home. And if there's markets down, you don't have any of the downside risk. So I'm going to cap you on the upside, but I'm going to protect you on the downside. Using that same kind of logic, and I can give you let's say a 7% trigger. I'm going to say, hey, anytime the market is flat or anything up, I'm going to give you a 7% credit or a 7% performance trigger. And what that's going to do is that's going to credit to the value of your home. It's going to lock in, and then every year is a fresh start for you. So just using that same logic is meaning anytime the market's down, you're fully protected. Any appreciation you've already had in your home, you keep. And again, looking at using that same logic, your house would actually be worth $158,687 in that example. Now, unfortunately, we all know you can't buy a house that way, but that's how a fixed index annuity works. That's where the power of protection the downside, but gives you a percentage of the upside potential. That's exactly how annual reset actually works. But I think it's also important to be asking really good questions. The best agents that I've come across over the years still do a lot of annuity business, ask really good, well thought out questions. Here's a couple of examples. How would you like a fresh start from the market conditions each year? Tell them that every year is a fresh start with their annuity. Is it important for you to keep your money or what you earn your money on? Remind them it's not what you earn, it's what you keep. Would you take less upside if your downside was protected? How would you feel to make sure your contributions or your performance never go backwards? These are all things to get people engaged in talking more about what's important to them, right? If we go down a little further down, this to me is another prime example of how to explain the value of annual reset with a train. I call this the cargo train example or a story, because sometimes, we all talk about annual reset or a cap or a trigger. We all understand how those things work, but the average consumer doesn't understand that type of stuff. They don't understand how that actually works. We know because we see it every single day and we talk about it every single day. To me, giving them a visual aid or something they can follow along and better understand the logic or how the basics of annual reset actually work, this to me is a great story to share. But I call it the cargo train. So think of the cargo train is your cargo or the premium or the money they're going to invest in this annuity. So this is their annuity train. We're going to add $100,000 of cargo to this train. And let's say it's for 5 years. So it's a 5-year annuity, let's say. So you're going to have 5 stops. At the end of that 5 stops, you're done. And that's what your contract value is worth at that point. So what I'm going to use here is that $100,000 example again. We're going to start with the first year. A year from today, the market, the S&P is down 20%. Now, luckily, with the value of an FIA, you have 100% downside protection. So your $100,000 investment is still worth $100,000. So you didn't take that loss. The next year, and I'm going to use an 8% performance trigger rate in this example. I have an 8% performance trigger. And if anyone doesn't understand how performance trigger works, is it's tied to the S&P. It's just saying the starting point today and the ending point, if they're the same, or if the market's up anything, it can even be up a penny, you'll get that full trigger rate. In this example here, in the year 2, when you get to that second stop, let's say the market's up 2% that year. Well, because it's flat or anything up, you get that full trigger rate. We added 8% interest to your cargo train. Now your cargo train is worth $108,000, and that's now locked in. The next year, the market's up, let's say 11%. You have an 8% trigger because the market was flat or anything up. You got that 8% trigger rate credited to your contract value. Now you're at $116,640. So again, you lock those gains in, you create a new floor in your contract value, and then year 4, the market's down, let's say 10% that year. You're fully protected. Your $116,640 is still $116,640. And then lastly, you have one more stop. Let's say the market's up, 7%. Well, again, if the starting point and the ending point of the S&P are flat or anything up, you get that full trigger rate. We credit you another 8%. You're now at $125,971. What this is meant to do is to mechanically show how annual reset actually works, but in layman's terms, in a way they can understand. So what you're saying is when the market's down, I'm fully protected. When the market's up, I get a percentage of the up. I'm going to lock those gains in. I create a new floor. So every year is a fresh start for me. Yes, that's exactly how annual reset works on a fixed index annuity. Let's go to the next slide. So we look at the next slide here. It's all about understanding where the opportunity is in your practice. And again, it's not a huge surprise. We're first going to talk about baby boomers, especially the senior market. In fact, if you look at the senior market based on the US population, last year, the senior market made up about 19% of the total population of the United States. By 2050, the senior population will be 23% of the total population of this country. So it's only going to go up. And the reason I bring that up is because boomers are a big part of that wave. We know that baby boomers have gotten a lot of attention in the last decade, and for good reasons. Look at the numbers. There's 68 million baby boomers. 11,400 are turning 65 every single day. That's 4.1 million people a year. And believe it or not, they control 53. That's not a mistake. 53% of all the wealth in the United States is controlled by baby boomers. And 42% of that population have investable assets of $500,000 or more. So this boomer wave that's been going on and will continue to go on. But what I find a lot of people kind of miss is that wave of retirees isn't going to stop. In fact, it's going to continue, because what's right behind them is my generation. I'm a Gen Xer. I'm 52. And what's crazy is in 2024, the first Gen Xer turned 60, which is crazy. Think about that. The Gen X wave right behind the baby boomer wave is right behind them, and they're going to have a lot of the same challenges and issues when they get closer to retirement. There's 65 million Gen Xers. 38% of them right now have investable assets of $500,000 or more, and we control 25% of all the wealth in this country. So between these two generations, we control the vast majority of all the wealth. So you wonder where the money's going to come from, the money in motion. It's really going to be between these two generations of people. So when you're thinking about people in your book of business, you're thinking about people in the files or prospects you're talking to, this to me is where you want to focus your attention, because at the end of the day, this is a big part of your practice. Because again, baby boomers have a need for protection and potentially for income. Gen Xers are going to have that same challenge, because Gen Xers especially are the first generation of people, unless you work for the state or the government, you never knew a pension. So you never even had an option to get a pension. All you've known typically is a defined contribution plan, or like, let's say, a 401k plan. So a lot of people are going to have the same challenges and needs that a lot of other retirees are having right now. So just want to make sure I kind of point out exactly who you should be targeting in your book of business. And by the way, in this year, in 2026, the first baby boomer turned 80. So again, when you think about the money in motion and the population of the target market you should be looking for, 100% it should be the boomers and the Gen Xers. Let's go to the next slide. So when it comes to National Life Group, when it comes to solutions, we have a very robust portfolio of products for you that you have available through financial markets. And of course, we have accumulation products without a bonus. We have accumulation products with a bonus, with very competitive rates, very strong renewal rate integrity as a carrier. We're very competitive on income. We have an income product that gives you a 25% income bonus, 10% simple roll-up for 10 years, an income doubler that is approved in California. And it's really competitive income, especially income in 5 years. So we do definitely have the product solutions for you, not only for accumulation or protected growth in accumulation, but also for protected income. Now, with that being said, we also have what's called the premium power pay that you have access to right now. And the great thing about our program, guys, is we reset the clock every quarter, but we do that for a reason, because the entry point on this to get additional bonus commission is actually relatively low compared to the markets. If you look at most carriers out there, they typically have a much higher threshold you have to hit to get any additional compensation. So you can see here that 100% of your fixed index annuity production counts toward the bonus. But if you do in fact do MIGA business, we do have relatively competitive MIGA rates for a 3 and a 5 year period of time for an A+ rated carrier. 50% of that production actually counts towards your bonus. So you actually get production credit on both products. Now for $650,000, if you do $650,000 or more production for the quarter, we will pay you an additional 50 basis points of commission. If let's say you happen to do $2.4 million in production for the quarter, we'll pay you an additional 1% commission paid to you the month following that quarter. And we reset the clock every single quarter. So this is something you're automatically enrolled in if you want to take advantage of, but it's definitely something that's available to you that the National Life Group does for our top producers. And on top of that, we also offer a producer trip every year. Next year, for this year's production, we'll be in Cabo. So next year in Cabo, on April 8th to the 12th, $4 million in FIA production gets you on the trip. So if you are looking for the ability not only to get additional commission and additional revenue you could put back in your business, we also offer a trip, all expenses paid for you and your partner. So just want to make sure I kind of point this out. This is a great thing that we offer here at National Life Group. We are A+ rated. We have a 90 Comdex score, and we're a mutual company, which is kind of a rarity nowadays in the brokerage world. So just want to make sure I kind of point this out that, you know, not only do we have competitive products, we also have competitive producer compensation, but we also have a producer trip as well. So with that, I'm going to turn things back over to Tara and see if there's any questions.
Thank you, Craig. While folks are typing their questions or thinking of what questions they have, you know, we get a lot of questions about, and you touched on it a little bit, that trigger performance. Can you explain that again, how that works, and why in your example, in the year that it was 11%, that only 8% was credited?
Yep. Yeah. Great question. Because I get this question all the time. It's like, why have performance trigger strategies become more popular again? I think a big part of that is the simplicity of actually how it works. Because if you think about the markets, and we just think about the markets in any given year. So let's just say if I put my money January 1 in the market, and by December 31st, that'd be a 1 year period of time, 365 days, just using that as a benchmark. So my starting point is here on January 1, and my ending point's here December 31st. There's only really 3 things that the market can actually do, right? We know there's only 3 things. It can either go up, it can go down, or theoretically, it can be flat. So when you think about a performance trigger, it's telling the client, listen, if when me and you get together a year from today on your anniversary, there's only 2 outcomes that can happen. You either got credited the performance trigger rate, because it will credit that if the starting point and the ending point are the same. Meaning you started out here and it ended here, and it's the same marker, it's the same number, starting point, ending point the same, we will credit you that full trigger rate. If the market's up anything, it could be up a penny, we'll credit you that full trigger rate. So it actually gives the client an opportunity to get more growth potential in a market environment maybe that isn't as bullish, right? So if the market's flat or anything up, we credit you that full trigger rate. So again, it just simplifies the story for the client, because you know when you get to see the client a year from today, there's only 2 outcomes. If the market's down 20%, fully protected. If the market's flat or up, you know they're going to get that full performance trigger rate. So it just kind of simplifies the story, and they have a better expectation of what a fixed index annuity can provide in terms of growth. Now, the downside of it is, to Tara's point earlier, if the market's up 11%, you're not going to get 11%. You're going to get the trigger rate. But what the trigger rate does do is it gives the client more opportunity to get a positive return, even if the market's flat or anything up. Because the market's up 2%, you get that full trigger rate of, let's say, 8%. So that's the difference. Is with a cap, an S&P cap, let's say a cap's at 9%, and a performance trigger rate's at 8%. Well, why would I do that? Cap's at 9%. That's true. Now, if the market's up a lot, you're going to get more upside with the cap. But let's say you had a 10% cap, but the market's only up 2%. Well, you can only get up to what the market did, right? So in that example, if the market's only up 2%, but your cap's 10, you're only going to get 2. So you have more upside, but you've also got limited amount of opportunity if the market's down, because you're just going to get whatever that was. If the market's in that 2 to 3% range, you have a 10% cap, you're only going to get credited between 2 to 3%. The value of the trigger is if the market is flat or anything up, even if it's up a penny, you get that full trigger rate. A lot of people tend to like the simplicity of that a lot better than some other strategies, let's say.
Thank you. Thank you for that. So looking here at this question, you kind of addressed this a little bit about why fixed index annuities have some crediting limitations, those caps and those par rates. So what would a response be to a client that says, so what's the trade-off? What's the catch?
Yeah, I think the question comes in is, I would probably say, what's more important to you? Is performance everything? If performance is everything and you want as much upside opportunity as you can be, then maybe you should be in the market, because that's obviously going to give you all the upside that you want. But the problem is going to have all the downside risk too.
Right.
Is having the ability to have protection on your money while still giving them the growth potential at the same time, is that more important to you? Is protection more important, or all the upside more important? I think it's very important to kind of distinguish what's the biggest reason that they want to invest in something versus the other. Because if it's all about the performance, then maybe they should be in the market. But if they really want to safeguard assets but still be able to grow it, it's especially outperform what other safe investments can give them, especially like money market accounts and CDs. I think it's all about asking the right questions and figuring out what's the most important thing to them. Because based on the numbers that we're seeing with money market account assets still continuing to go up, even though the market's been up, I think that's a huge red flag for what people are feeling right now, and they're afraid of loss, they're fearful of loss. So I think that protection part of it is very, very important. It should be a very important discussion point when you're talking to clients.
Good. You do, folks, you do have the option to raise your hand if you have a question. I don't see any other questions in the chat box. Neil, do you see any hands raised that we could open up those lines?
I do not see any hands raised, Tara.
Okay, well, we will move on. If you have or you think of an additional question, please reach out to your internal wholesaler. We're here for you, and we are ready to answer those questions. Or if there's a case that you're working on, give us a call. We always look forward to those calls and discussing what your clients' goals are. And like Craig was talking about, and one of the greatest advantages of a fixed indexed annuity is that protection, being able to protect what you already have, and like Craig said, capture those upside opportunities. So thank you, Craig, for your time today, and thank you to our advisors on the call. We do appreciate your time, and thank you for spending it with us. From your team here at Financial Markets, have a beautiful day.